you're looking to buy a house and you're reviewing all the documents and all you see is a ton of acronyms. I mean, you got PMI, you got TNI, you got ARM, and then there's the other stuff like your caps, your adjustments, your index, your margins. What does it all mean? Well, today we're going to break it down on this episode of Cash Clips. Today, we're making sense of mortgages. You're looking to buy a home, and one of the biggest things to think about and one of the biggest things that can impact your monthly payment is your taxes and your insurance. Now, taxes are pretty straightforward. They're set by your county, they're set by the city, they're set by the state, and it's a lump sum that you have to pay annually. Your insurance, that covers your home. If anything happens to it, you know that you've got that coverage in place. Now, the thing about your taxes and insurance is that they're big costs. It could be thousands of dollars per year. And when it comes down to paying for that, it really ultimately impacts your mortgage payment. It's like a separate budget line item. And that's where an escrow comes in. So an escrow is a special account set up by your financial institution that averages those annual costs out into monthly payments. So you don't need to worry about setting aside that money for yourself. Your escrow just takes care of it. It's part of your mortgage payment and you're set. On the topic of escrows, that typically comes down to your loan to value. Now, a lender might call this your LTV. And ultimately what it is the relationship between how much your home is worth and how much you owe on your mortgage. So for a simple example, let's say that you have a house worth $100,000, but you have a mortgage of $80,000 on it. Your loan to value is 80%. That 80% number can also be important for something called PMI, or private mortgage insurance. So private mortgage insurance is a separate type of insurance that covers the lender in case you default. So generally, if you have a loan to value of 80% or more when you do take out a home loan, you're going to be required to pay PMI. Once you get below that value though, chances are that extra payment per month is going to fall right off. And one thing to keep in mind about that PMI is that it will add money to your monthly payment. It could be the difference of tens of dollars, it could be the difference of hundreds of dollars. That depends on your loan to value and ultimately what your down payment's going to be on that house. Now onto the down payment. Now, old school logic says you should be putting 20% down, but quite frankly, that's just not realistic for a lot of people. And lenders have realized that. So when you're looking for a mortgage, down payment requirements may actually vary. You might only have to put 5% down, 10% down, maybe even no money down. That's why it's so important that you look at all of your options between your lender and what they offer. You've probably heard of the term closing costs before, and you also probably know that they're a lot of money. But the question is, what are you getting for that money? Well, for the most part, it's just a lot of setup costs, some of them to the institution, some of them to your lawyers. So you're looking at your origination fees. Think of it like a startup cost for your mortgage. And then you have your title and insurance fees. Sometimes you might need to do a prepayment on your property taxes or your insurance. And then of course, there's the attorney costs. There's a lot of paperwork you're going to be signing and your lawyer wants to make sure that they're paid for it. Now, closing costs can be thousands of dollars. A lot of things go into them. So when you're looking for a mortgage, ask your financial institution, see if they have a no closing cost promotion. That can save you a lot of money up front that you can put on your down payment or even just moving in and making your house a home. One of the biggest choices that you're going to have to figure out when you take out your mortgage is, are you going fixed or are you going adjustable? Now, a fixed rate mortgage, it's pretty self-explanatory. Your rate's the same for the entire term. Chances are your payment's going to be fixed right where it is. Adjustable rate mortgages, otherwise called an ARM, those are a little more complicated. So let's talk ARMs. Now, when you're looking at that rate sheet online, you're probably saying 10-1, 5-1, what does that mean? Well, to put it simply, that first number is how long your rate is going to stay the same, and then the second number is how often your rate might change during the term of your loan. So if you have a 10-1 ARM, that means that rate is going to be the same for the first 10 years of your mortgage, and then it can adjust once every year after that. So you know that your rate can change with an ARM, but the biggest question is how much? Well, that's where your adjustment caps come in. These could be an annual cap and these can be a lifetime cap. So let's say that you have a cap of 2%. That means that your rate can never go up more than 2% for that year, or maybe even for the lifetime of the mortgage. So ask those questions, see if it's the right fit for you. And remember, an ARM might not be for everyone, but they typically come with a lower initial rate. So if you're only planning on being in your home for a short amount of time, an ARM might be a valuable thing to look at. Last but not least, there are points. Points are another one of those things that you've probably seen on the rate sheet when you look at it online. Points are basically a way to lock in a lower rate off of what's advertised. So let's say that you pay 1 point, that might knock off 0.25% of your interest rate for your mortgage. Points are typically 1% of your mortgage balance. So put simply, if you have a $100,000 mortgage, 1 point is going to cost you $1,000. Whether or not that's worth it, well, that's up to you and how long you're planning on being in the home. Make sure that you check out an online calculator to see how a point could impact you and your payments. So we could talk about mortgages all day because, quite frankly, they're complicated, but they don't have to be. Stop into your financial institution and ask them questions. They're there to help and they want to. So I hope that you enjoyed this video and I hope that you learned something new about mortgages. I'm Devin from Cash Clips with Visions. Check out our other videos, give us a like, give us a subscribe. We got a lot more content out there.